This is E2B, Energy to Business, a podcast by Opportune, where we bring you in-house expertise that serves all energy sectors. We examine emerging financial and technology trends and provide a broad perspective on ways to stay ahead, create opportunities, and execute market strategies.
Hello, everyone, and welcome to another episode of E2B, Energy to Business, an Opportune podcast. I'm your host, Daniel Litwin, the voice of B2B. And folks, thanks so much for joining us on another episode of the show. We've got a lot to break down today, and we're going to jump right into it. Before we do that, though, I got to make sure that you're all caught up on previous conversations. So make sure you're going to our website, opportune.com. Again, that's opportune.com for previous episodes of the show, as well as more information about our solutions and services and other content like white papers, blogs, videos, and more. You can also subscribe to E2B on Apple Podcasts and Spotify. So just hit that subscribe button and you'll get a full catalog of previous conversations as well as notifications when we drop new episodes. So for today's conversation, we're going to be analyzing an important but maybe under-referenced report for the industry. That would be the Haynes and Boone Borrowing Base Survey. So for those not familiar with Haynes and Boone, they are an international law firm that conducts this borrowing base survey twice a year. And it's with the goal of providing a, quote, forward-looking and clear idea of what lenders, borrowers, oil and gas producers, and others are experiencing regarding borrowing base redeterminations in light of the price uncertainty in the commodity markets, end quote. So that's a lot there, right? What does this actually mean for our audience, and how are current oil prices impacting the ecosystem of banking and finance capital around the oil and gas industry? Well, here to weigh in is Steve Hendrickson. He's president of Ralph E. Davis, an Opportune company. Steve, welcome. Great to have you on. How you doing?
Thanks.
Well, fantastic. Again, Steve, it's great to have you rejoining us. You've been on the podcast a few times, so hopefully our audience is familiar with the kind of perspectives and insights that they're getting ready to hear from you. But just for a little brief refresher, can you break down your role within Opportune and how some of your work connects with today's topic?
Yeah, sure. And I'll give you a little bit of background as well. So as you mentioned, I'm the president of Ralph E. Davis, which is a petroleum engineering firm. We focus primarily on reservoir engineering, reserve studies, things like that that relate a lot to the value of oil and gas assets. We do a bit of other technical work as well. By way of background, I've been in the oil and gas business for really over 40 years.
Fantastic. Steve, thanks again. And I'm excited to pull from your wealth of experience in the industry and your various insights. They'll definitely be valuable here. So again, this topic, right, breaking down the Haynes and Boone survey is going to be treated like a barometer to gauge banks' lendability, so to speak, specifically to the oil and gas industry. And so Steve and I are going to be, for our audience here, we're going to be looking back at the survey's findings in their latest report. So let's go ahead and shoot it over to you, Steve. When we talk about borrowing bases in general, let's get that out of the way and define it for our audience, right? What is a borrowing base to the layman, and how does it pertain specifically to the oil and gas industry? Sure.
Well, borrowing base is a term that is related to what's called reserve-based lending. You step back and think about borrowing money of any kind for any reason. We kind of have two broad categories of debt, if you will. There's secured and there's unsecured. And, the common way, people can think about that as unsecured is basically there's no collateral, if you will. It's just your promise to pay. And a good example of that is like a credit card. Credit card debt, there's no security that if you don't pay, they come and take it back like they might your car if you didn't make your payments on your car loan. A good example of secured debt is a mortgage, right? You borrow a bunch of money to buy a house, and if you don't pay the money back, well, then they take the house and sell it in order to pay themselves the loan back. So reserve-based lending is a secured form of debt. And in that particular setup, the security, the underlying collateral, if you will, is a mortgage on the producing assets of the company, the oil and gas assets. And so the borrowing base is a calculation that's typically made semi-annually. It's made at the beginning of the loan and then every 6 months after the loan has been originated, to check what the value of those remaining assets are. You'd say, well, why do we need to do that, right? We don't really do that with our house when we borrow against it. Well, oil and gas assets are depleting. So as time goes on, you're taking money out of them. And so inherently they would be worth less in the future than they were today just because of production. But of course, prices can change, and that can change the underlying value. And you may spend some of that money you've borrowed. I mean, this is why most people borrow it, is they're going to do some drilling with that and hopefully grow the asset, grow the production, and grow the reserves. So it's possible that even price changes aside, that through successful development, that the value of the assets actually goes up over time. And this gives borrowers the chance to have more credit availability to continue to grow their business. You can kind of think of it as a little bit like a line of credit as well. And it's just, what is that credit? What is the magnitude of that line of credit from one point in time to the next? So why these things are important is because when there are especially big negative price changes, typically borrowing bases go way down. And if the amount of money that is outstanding, that is, you've borrowed a certain amount of money and you owe that back to the bank, and the borrowing base is less than that, well, then you are obligated to repay the difference pretty quickly. And if you don't, you're in breach of your loan covenants, and that can start a whole series of bad events. So borrowers who use reserve-based lending are always very concerned about what their borrowing base does from redetermination to redetermination.
Perfect. Thanks for that clarification, Steve. Again, some background on what a borrowing base is, reserve-based lending. These are essential concepts for oil and gas development. When it comes to redetermination, just kind of as a whole concept, let's give a brief definition there too. What does redetermination mean? And how does this dynamic of going to a bank multiple times to get a line of credit impact the oil and gas industry?
Right. So once these lines of credit or revolving credit agreements are established, they usually have a term of about, it can vary, but usually it's about 5 to 7 years, and then they'll have to be renegotiated, right? Provided that everything has gone, fine up to that point. Nothing has happened prior to that in a bad sense. And so the borrowing-based redeterminations happen, as I mentioned, typically twice a year. And what happens is the borrower, the operating company, will commission a third-party reserve report that will be delivered to the banks and serve as the basis for their, what I'll call their underwriting calculations, where they determine what that borrowing base is worth to them. And they have their own price decks that they use and a number of other parameters that they consider, that when they see the reserves as described in this third-party reserve report, they are able to use that information and derive the amount of borrowing base they think is appropriate for that and their risk tolerance. And very often these loans are actually syndicated. So there might be, I'll just make up some numbers, there could be a $500 million credit facility at origination. But not one bank would be willing to loan. Typically, there aren't many banks that are willing to do a loan of that size. And so it'll get syndicated amongst a number of banks, each of which have a small percentage of it, maybe 10, 15%. Maybe the agent bank has a pretty large piece. But then they'll have to submit, each of them, what they think the borrowing base should be, and then the agent bank will come up with an answer that is satisfactory to all or almost all of the lenders in the group, and that gets communicated back then to the borrowing company.
Perfect. Thank you, Steve, again for that background on borrowing bases, redetermination, and just that whole important interface between the bank and the oil and gas producer, and breaking down what they're supposed to do, which is develop hydrocarbons. So, yeah.
And of course, a lot of the work that we do is in support of that activity, right? We sometimes will do reserve reports for borrowers, and sometimes we'll assist lenders in their assessment of those reserve reports that others have done to help them with their underwriting.
Yeah, that's right. That's right. And let's go ahead and jump into the report from Haynes and Boone then to get a little bit more specific and actionable. So my first question to you here, Steve, is in the Haynes and Boone's most recent survey, it came out in April. It's currently June. Most of the responses indicated that they expect to see substantial borrowing base increases this spring. So again, respondents are indicating in the survey that they expect to see substantial borrowing base increases this spring. What are some of the overarching factors that are supporting this conclusion, in your opinion and in your analysis, and why?
Yeah. Well, I think the question relates to the question 2 in their survey. I think they have 5 questions in their survey, which deals with what they think the borrowing basis will do. And as you mentioned, most of them think they're going to go up by 20%. It's kind of the most common number, both in terms of borrowers and lenders. But there's a substantial, if you look at the 30 and 40% increases, you'd say that at least half think it'll be 20% or greater. So as I mentioned a little bit about the mechanics of how these things are determined, there's really 2 main drivers. How much future production are you going to have, and what will be the commodity prices that those are expected to get. There's a kind of a third component that goes along with the prices, and that is the hedge position that they've had, because the banks do give credit to the hedges that the operators have taken or have entered into. So we talked about pricing, oil and gas future prices playing a big role in what borrowing base redeterminations will be. The banks don't use the strip price deck that a lot of folks are familiar with, the NYMEX price curve, for instance. They each develop their own internal underwriting price decks. And those are always, I'll say always because that's been my experience, at a discount to the NYMEX curve. They're not all the same, but they develop those independently. And so when prices in the market go up, like we're experiencing right now, their price curves move up too. They don't necessarily move up as much, but they do go up. So price changes are generally the most significant driver to period changes in borrowing bases. As I mentioned, also another factor is production, right? So if you had gone from one period to the next and had been drilling and adding new production, even though you were producing volumes from the existing wells, now you've added additional wells which are replacing some of that production. So it's possible that you really don't have a production change, and so that may not be a factor. But if, let's say, you're an operator that, for whatever reason, has chosen to reduce the amount of drilling you're doing, or maybe you're not doing any drilling, you could find yourself in a situation where your remaining reserves are less than they were when you had the last redetermination. And so that could be a driver. I think what we're seeing here in this particular survey question, though, really relates to price changes.
Yeah, I mean, it certainly looks that way, right? And that kind of dovetails me into my next question, which is also based on some of the responses in the survey. So respondents are reporting lower hedging percentages in this spring survey compared to the last survey conducted, like you mentioned just a bit earlier. Why do you think that is, right? Break down that dynamic and the factors at play.
Right. And so this question kind of, they ask about the next 12 months in particular. And most operators are going to have a hedge book that extends longer than that, those that choose to hedge. And I'd say some meaningful percentage of hedging of their future volumes up to maybe 3 years out. Some go further, some will be less, but it's 1 year is a pretty short time frame for a hedge book tenor. So I think this is a good question to point out that the responses, we have different types of respondents in this survey. Some are lenders, some are borrowers, some are other people. And so when we think about the question regarding, well, what does your hedging look like? compared to a prior period. Now, question 3 doesn't show what the prior period answers were, so we have to take Haynes and Boone at their word here that these are lower volumes. But I would be focused mostly on the borrower responses, not so much on the lenders. The lenders know something about their borrowers, but the borrowers know a lot about their own operation. We had 105 respondents here. 30-some% of them, about a third, were in operating companies. So just kind of keep that in mind, the sample size. So we're seeing that, we have less hedging than they observed last time. And it talks about as a percentage of future production. All right. So it's important to keep in mind that there are two sources of future production. There are the wells that exist today, and there's the wells that I intend to drill in the future. And this question doesn't really ask about what percentage of what volume. It says the total. So it could be it could be possible that from a PDP producing standpoint, hedgers aren't hedging anything different than what they did in the past. They're just now expecting to have more undeveloped volumes come online because prices are higher and they plan to drill more. So it's a little hard to say what's really going on in producers' minds on this. What this question is just a little bit too vague to really draw a lot of conclusions from. Now, we have had some conversations with others in the industry, and I do believe that there was a lot of pressure a couple years ago by banks in particular, perhaps some other capital providers, to put a lot of hedges on because folks had kind of gotten burned in a downward market. So there was a lot of hedging. And then prices took off and folks start to feel like, well, that may not be such a great idea. Now that I'm paying out on all these hedges, maybe I don't want to do so much of that. And so I think that's a realistic reason that some might not be hedging as much. But another factor we've noted is that the forward curve, the prices that are expected and that you could hedge into in the future if you're using swaps, is quite a bit lower than where the spot prices are. And as a result, so for instance, you might be sitting at $100 or $110 today and say, well, what kind of price can I hedge at 2 years out? And see that price is $70 to $80. And you'd say, well, I don't think I really want to do that. Why do I want to lock in $70, $80 when it's 100 plus today? And I think that tends to restrict or at least reduce the amount of hedging that some companies choose to do.
That's great, Steve. Thank you again for the breakdown there. Again, hedging is a quite complex aspect to forecasting what a driller might produce in the future, and it's kind of an insurance to lock in a certain price in the future on what you're going to sell your commodity at, and then if it doesn't hit that certain price benchmark, there's quite a bit of risk there, right? That a bank and then a driller have to take on. Would you agree, right? Is this, that important of an aspect for forecasting production in the future, a ways out, right? What are your thoughts?
Yeah. This business, has a lot of commodity price risk, right? Because you make an investment decision today, you'll spend millions of dollars, and the return on that investment comes over a long time in the future, several years typically. And that return, the money you get back, is strongly influenced by the price. Basically revenue is volume times price. So either, you got volume risk and you have price risk. And there's not much you can do in the financial markets with respect to volume risk. But price risk has a number of techniques, which we kind of throw under the term hedging, to try to mitigate at least a portion, maybe a significant portion of that risk. So it is complex because there are a number of different tools that can be used, and it takes some pretty detailed modeling to be able to understand what the effects of the hedging decisions are when prices start to change.
Yeah, that's right. Right. And we're seeing that today, right? Drillers today, and when I say drillers, I mean E&P companies, right? Exploration and production companies. They're enjoying pretty good cash flow right now. So that leads to the next question on the survey. And that's, while cash flow is obviously strong for operators and it's, king of capital sources right now, the survey in Haynes and Boone, noted several notable changes regarding how producers are funding themselves. It's actually becoming a more differentiated and varied pool. So, for example, the use of equity capital, both public and private, as well as bank debt, the use of all of these are increasing. Does this square with what you're seeing in the industry, right? Are you seeing the same thing amongst your clients? And if so, what alternative means of funding could be occurring here and could be laying some fresh foundations for the industry?
Well, I think let's start with maybe a little bit of a backdrop on kind of coming out of the 2018, 2019, or even into the pandemic, right? The downturn that the industry went through. And the downturn was kind of accompanied by a change in the maturity, I'll say, of the unconventional plays in the United States, right? So if you go back a decade or more, those plays were all emerging, evolving. There was a land grab in every one of them as people tried to get leases together, drill, figure out if they were in a good spot, figure out how to make it work, to add value, and, sell the company or, primarily that was kind of the buy and flip mode that was predominant in the industry during that time. And eventually all the acreage got taken, it was all leased up. The plays were figured out, I'll say, generally or broadly speaking. And so the buy and flip mode began to diminish, partly because of just the natural maturity of the business, but also because there were a lot of people who did not end up with very good returns as they were investing in companies that were just continuing to spend money to grow, especially if they were raising capital through debt or through additional equity raises and just plowing that money back into the business. And then when prices dropped and I'll say the music stopped, they weren't getting the returns that they had been anticipating. In fact, a lot of people lost a lot of money. So investors decided, we're kind of tired of that, and we're not going to be putting. Banks said we're going to have tougher underwriting standards. We're not going to be putting as much debt in. We may not be doing as many loans as we did in the past. Equity investors they were like, well, I'd like to start seeing some of this money come back to me sooner rather than later. So I know that you're making good decisions. And the combination of all those things resulted in companies having to live pretty much on cash flow as a source of capital. Cash flow is always a source of capital for oil and gas companies. I kind of call it the internal capital market because it's money that's coming off of the assets that they control, and they can do pretty much whatever they want with it. They don't have to, other than the general things they have to say to their investors, they don't really have to answer to folks as much as they do when they're trying to raise additional capital. So that was kind of where things had evolved to. And so we weren't seeing as much debt and as much equity come into the space, and companies were just living on the cash flow that they had. Now we're seeing, increased equity interest, and we're seeing increased debt issuance. And we're seeing what I think is probably the most interesting part of this is we're seeing a rise in some of these other types of capital sources that hadn't really been, either they're new or we haven't heard from them for a while. So we've got like these monetization transactions that Haynes and Boone referenced, volumetric production payments, override type structures. We're also seeing these alternative capital structures, which are kind of typically like term loans. So comparing a term loan to a reserve-based loan, you don't know, as long as you're below your borrowing base in terms of your borrowings, you don't owe any money back until the very end. Term loan typically is, it has an amortization feature. It doesn't have to be this way, but it's kind of more common, at least in what I've seen, is that it's kind of like your house. Your house is a 30-year mortgage. Well, it has a 30-year term, and you're paying it off as you go, and you get to the end of the 30 years, it's all done. Now, it's possible to have loans that are like a bond where you basically pay interest on that, and then you owe all the money back at the maturity date, which may be 5 or 7 years in the future. But my point is, we're seeing a rise in some of these alternative structures. We've been working with lenders that are providing those to do technical diligence work, and we're seeing that to be a pretty active space. So, although the Haynes and Boone survey doesn't really drill down on that, to me, what I see is I do see maybe improved participation from the commercial banks in reserve-based lending, and I'm seeing a lot of debt issuance from what I'd call non-commercial banks. They're going to be investment banks and other funds that are putting together these debt-type instruments.
Oh, yeah, that's interesting. Yeah, creative financing. That's kind of the the core mission here, right? E&Ps have to adapt, they have to evolve, and that's just one way of doing it, right?
Yeah, and it's all about investor appetite, and investors have certain risk tolerance and they have certain return expectations, and this business has its own sort of risk returns paradigm, if you will, or dynamic, and so the creativity comes in bankers coming up with means to put structures together that are appropriate for the risks that the companies face and the potential for returns that they have, but also are meeting the needs of the investors pool right now. And that changes as market conditions change, both within the oil and gas business and in the broader market.
Right. Yeah, that's great. Thank you for the input there, Steve. That actually segues me pretty well into my next question here. So, again, hearkening back to the survey, it looks like respondents reported that the most important impediment to increasing oil and gas production is actually one that's going to take some time to reverse, and that is the lack of reinvestment in the industry over the last couple of years, right? That need to make up the ground that was lost during the downturn, a drying up of reinvestment. So to get your analysis and opinion on this, what kind of things can producers do, or what kind of things are you seeing producers already doing to reinvest in the industry, to make up that lost ground?
I think on this question, again, it's important to note the respondent group, right? We've got about a third of the respondents here are actual oil and gas operators. Now, their bankers know something about those operations, but I would have liked to have seen this question split up just like they had done the others by the type of respondent, because I'd be most interested in what the operators have to say about this. So when we think about, so they've responded, this group says that the most significant impediment to growing production is the fact that we haven't invested in the past. And you kind of think about that and say, well, what does that really mean? I mean, if I'm trying to grow from today, what real difference does it make what I did in the past? About the only thing that I can say is it's kind of maybe a startup issue, right? So a lot of companies, when they decide to stop drilling or are forced to stop drilling, they have folks on staff and whose job it is to drill wells. And if you're not drilling wells, you may decide, I just can't afford to keep the staff around for 2 years until I'm ready to start drilling again. And that could be like drilling engineers, or regulatory people, drilling foremen, land people. So I could see a certain turnaround time, if you will. If you decide, well, you just can't decide today necessarily that I'm going to go from no rigs to 3 rigs because I may have to staff up a little bit. All right. So that could be one reason why failure to keep rigs running in the past makes it harder to get them going again. We always face the problem of declining base production. Even when we see production growing, the thing to keep in mind is it's just growing because we're adding new wells, not growing because the wells are producing anymore. Underneath all that is declining production. Every one of those wells, with a few exceptions that probably don't make any difference in this context, they're all declining almost immediately from the time they're placed on production. So to grow production, we always have to overcome that decline. Even if we're even if we're growing, to keep growing, we still have decline we have to overcome. So the lack of reinvestment, I'm a bit surprised to see that being number one, but okay. Number two, lack of access to capital. Now, I think this is an area, as we talked about a minute ago, that may be getting better for some companies, partly because, what's the primary source of capital for most companies is their cash flow. And if prices are going up, there's a good chance their cash flow is going up. Now, if you hedge 90% of your production at some lower price, you're not going to see a lot of the benefit of these price rises. So those operators may not really have much more cash flow to work with, at least today. But as those hedges roll off, and provided that prices stay up, then eventually that will happen. But what we do know that in some respects there is some capital starting to come back into the space. I don't think it's anything like what we had seen in the past, but I also don't think it's as bad as it was, in the most dark days, say 1 to 2 years ago. I do think, another thing that they point out, lack of competent rig crews. And I think you could, they basically, that's kind of a labor issue, right? It's a very narrow category of labor, but you could have said labor in general, not just for rig crews, but also for frac crews and other operations personnel. Those folks, just like when you stop drilling, those folks are out of work, and you stop fracking or you reduce fracking, those folks are out of work. And so are the guys that are running the wireline crews and the MWD equipment, et cetera. There's a lot of people who don't have anything to do when rigs get laid down. Many of those people will move on and find something else to do. And, it's going to be difficult. Some of them will never come back to the industry. Some will have to feel like, hey, this is actually a sustainable environment that I'm willing to go back into. To get some of those folks back is going to frankly require more money. It's going to require higher pay to incentivize them to come and do this work from whatever it is they're doing right now. And of course, that just contributes to higher well costs, which starts to squeeze out some of the higher revenues that we're getting from higher prices. And as a result, some folks may say, by the time I look at what rig costs are doing, and even with higher revenues, this may not be a good opportunity for me to drill. And so, not everything that might be perceived to be economic at $100 a barrel will be once higher prices are factored in. And we are seeing some cost pressures, I think, both in terms of labor, but also in terms of steel. We're seeing delays in steel availability. I read an article maybe a month or so ago about steel mills, and they're enjoying some pretty high prices right now, but they're also faced with some high costs, and they have a lot of reluctance to just build up pipe inventory and have it sitting on the ground, place millions and millions of dollars worth of their capital into inventory. If the oil prices aren't sustained at these prices and the rig count drops, and they're kind of left holding the bag again. So they're making pipe more when it's requested, and that or they're taking orders and then starting to make it, and that kind of turns into delays that we didn't have in the past. It may take, depending on who the operator is, it may take a couple months to get the casing and tubing that are needed in order to complete the wells. So I do think that those sorts of factors are significant.
Yeah, historical, right? Yeah, that's a great point, Steve. And as if that's not enough to compound the headwinds for the industry, right? Inflation, labor, materials, ESG is also a thing in the industry. And as we've seen and discussed on this podcast many a times, it's taken the industry by storm. However, despite all the current focus on ESG, respondents in the survey said that they see it as one of the least important impediments to increasing oil and gas production. Does that surprise you at all? Right? What was your take or your opinion upon seeing that response?
Well, not really. I mean, I think there's a couple things. So, ESG, environmental, social, and governance. Those are not new ideas. Companies deal with those problems all the time. I think what we're seeing right now is a greater interest in transparency around all three of those. And I'll say there already is some level of disclosure around all those. It's not like these are completely hidden, but there's greater interest in that. And so the question is, what sort of things are regulators going to require, specifically for public companies, the SEC, to make better disclosure? And I think, there's some I guess some preliminary guidance that's been issued by the SEC. I have to admit I have not studied that, so I don't know what the impact of that could be. I will say those sorts of rules take a long time to be promulgated. There's a whole administrative process around rule writing, rule review, comment from industry, et cetera. So it's probably a little early to say where that's going to settle out and what the impact would be. And absent that, not a whole lot has changed other than an awareness that there is greater interest in this. And some companies are starting to take a more proactive view to make greater disclosure. They're trying to get out ahead of where the regulators may go. And it makes sense. I think some investors too are also asking more questions than they used to. We see that in the public markets. So we see that, through some shareholder activism. And I'm sure it's occurring in the private markets where you have the large funds and their big limited partners, or, be things like endowments, pension funds, maybe family offices to some degree, probably, not so much, sovereign wealth funds, et cetera, that are just asking more questions than they had in the past. But those questions, while they take time to answer and there's a lot of cost involved in measuring some of these things, they're not really operational issues for the most part. I mean, some of it is. I don't want to say that they're not all, but, when you're talking about governance issues and about who's on the board and how the board works, well, that's not a drilling investment decision.
Right. Well, one thing's for certain, at least, ESG is not going away. There is an outsized focus both within industries, right, with pressure from industry organizations and to maintain a competitive edge. But then also just kind of at a macroeconomic level, we're even seeing, fresh standards at a federal level pushing for ESG compliance. So again, it's probably not going to go away. It's probably only going to intensify as green agendas take shape in public policy across the state, local, federal levels.
Yeah, I think that's a fair statement. I agree. I don't know exactly what form it's going to take, but I do think that we're seeing a heightened level of a desire for greater accountability on these topics, kind of across society, if you will. And so those requests for information and to understand what companies are doing and to hold them accountable to some standards in these E, S, and G realms, I think that's real. And I don't see any reason to suspect it's going to go away.
Oh, yeah, I'd have to agree again. Steve, well said. So I think with that, Steve, we'll go ahead and wrap it up. So thank you again for your time and your great insights. I always appreciate getting to chat with you and pull from your years of experience to get a better pulse check on the industry and turn it into some actionable insights. So again, folks, we've been chatting with Steve Hendrickson. He's president of Ralph E. Davis, an Opportune company. And Steve, if folks want to learn a little bit more about Ralph E. Davis, I'm going to point them to opportune.com like we normally do. But if folks want to learn more about you, right, or they want to reach out, pick your brain on this topic, how can they get in touch?
Well, yeah, that's the best place is go to opportune.com. We have a webpage there that deals with our practice of reserve engineering and reservoir engineering. There's a contact links on there. I always like to stress to people too, we mentioned it a little bit, but we do put out a newsletter each week. That newsletter has a lot of really handy statistics in it. We try to include content that I think folks would find very useful. And there is a page on our webpage where you can both sign up to receive it each week in your inbox, or you can just go back through and look at previous archived versions. They're all out there. So that's the best way to get a hold of us.
Absolutely. Well, with that, we'll go ahead and wrap things up. So Steve, thank you again. It's been a pleasure, and I'm looking forward to the next one because I'm sure we'll have some more conversations soon. Take care.
Okay, my pleasure as always. Thanks.
And thank you everyone for tuning in to another episode of E2B, Energy to Business, an Opportune podcast. If you like what you heard today and you want previous episodes, or you want to make sure you don't miss out on future conversations, make sure that you're heading to our website, opportune.com, and subscribe to the podcast on Apple Podcasts and Spotify. I'm your host, Daniel Litwin, the voice of B2B, and we'll catch you on the next episode of E2B.